Now, the World Bank cuts its outlook for global growth due to worsening prospects in China, but is it being overly cautious on China? Well, Bloomberg Economics says the factory data last month gives the PBOC room to ease monetary policy. Well, joining us now is Freya Beamish, Pantheon Macroeconomics Chief Asia Economist, and Neil Duane of Allianz Global Investors is still with us. First of all, Freya, talk to me about U.S.-China, the trade deal. How much does that help the Chinese economy?
It's already starting to show up a little bit in the PMIs. We have the December PMIs there, so we have that little confidence boost coming through, even though we did see a drop there, but the Caixin was already quite far above its trend. So we're starting to see that confidence coming through, and it does really make a difference because, as I always say, monetary conditions are still very tight, and that confidence is amplified in that kind of a situation. The big thing to note about the Phase 1 deal, though, at this stage is that we still don't really know what it is, and it's a week away before it's supposed to be signed. It does look like the Chinese will attend. It does look like Xi Jinping won't be there, but Liu He, who's the next key person, will be there. But these numbers that are coming out, the $200 billion of dollars of goods that they're supposed to purchase over the next 2 years from the US. When I saw that number, my honest reaction was to scratch my head, because if you look at the Chinese imports data, which it seems that Mr. Trump hasn't done, you see that actually before these trade tensions started back in June 2018, at that stage imports were only 150 billion a year from the US. So even if you add on services to that, then you still can't really get to 200 billion. So it's hard to see how you get from that, from those types of figures to adding 200 billion over the next couple of years. And similarly with the 40 billion of purchases from agricultural goods, that number's a bit of a head scratcher as well.
Freya, over the last 3 to 4 months, insolvencies in China and defaults in China has significantly increased. Is that just the authorities letting out steam, or could it be something more sinister?
There definitely is a lot more sinister that's brewing under the surface. The question is whether they'll allow that to come forth. It does look like we will see a bit of a recovery in the economy this year. We're starting to see some green shoots coming through, but they're quite limited, and maybe we can talk about why that is. And broadly, it's more of a stabilization at this stage than an outright recovery. So that we think that there are a large number of bad debts that are still to be realized, and there's still a great deal of pressure on a structural sense. But cyclically speaking, at least the PPI is turning in the right direction now, and that should help profit margins. And the authorities are trying to tide things over in terms of injecting liquidity into the banking sector. But it's all very much piecemeal, fighting fires as they arise, rather than really grabbing the bull by the horns and trying to deal with the underlying problem with a proper bank recapitalization.